All right, so we'll go ahead and kick off here. So yeah, I mean, this conversation, obviously, hopefully there's some questions that come through along the way. I want to make sure everyone gets something out of this, and really just want to talk about kind of some of the kind of I would call it tax 101, some of the things that people should just be aware of if you have a business, whether it be a startup, small business, regardless. We kind of frame this for companies under a couple $1 million of revenue. I'm sure there's a lot of different industries involved here. I know we use the term ARR, but really that's just to, indicate revenue size. So, before we kick off, maybe what I'll do is kind of give you a little bit of background on myself and our firm just for context, and then we'll dive right into the materials. So I came out of school at UNLV a number of years ago, joined Ernst Young right out of school, and worked there for a little under 7 years. And then at that point, I jumped out with two other people that I had worked with at Ernst Young to start KBF. KBF has grown from 3 people to about 230 people over the years, and we're kind of considered a specialty tax and advisory firm is really kind of where we fit in the marketplace. Pretty heavy on the tax side. We do a lot of corporate tax work. We serve about 200 public companies and then just hundreds and hundreds of venture-backed and private equity-owned companies. We do work with some dynamic privately held as well. While we do serve a lot of public companies, I spend most of my time serving what we call emerging growth clients. So kind of earlier stage. I enjoy that space. I enjoy helping companies get going and go to scale. And so, heavy in the tech and the life science space, and because of the nature of our clientele, my clientele, I probably do 10 to 15 exits a year, somewhere in that range. I've done about 25 IPOs, and so just being around a long time, we've seen a lot. And we think that adds value to our client base, and just people who have been through the full cycle a number of times before. So enough about me and KBF. Just want to make sure everyone understood kind of where we were coming from. So here, just kind of again summarizing who we are. And so, talking about tax early stages, I think, we hear a lot people say, oh, there's just not that many transactions, not that much going on. But I do think that tax is a key consideration, to set yourself up for long-term success. A number of things we're going to talk about here today kind of talk about formation and what type of entity you may or may not want to be, depending on where you're ultimately going. And there is no one perfect entity type. It really depends on the nature of the business and what you think the end game is. Is it a cash flow play? Is it build and exit, type of situation? And most of the clients we serve are in that latter bucket, and they are looking to grow, oftentimes take on capital, scale, and then ultimately have some sort of liquidity event. And that's what we do a lot of. We do have some other clients though that are purely cash flow. They're consulting firms, law firms, things of that nature, where there maybe isn't an exit at the end of the day, and they're looking to maximize earnings, maximize or minimize tax rates, things of that nature. But and there's some penalties, not only financial penalties. There are those if you don't do things correctly, you can have a number of penalties and just a whole variety of areas. Income tax, payroll is the most common, honestly, for very early stage. And it kind of drives your ability to take investment. And we're going to spend some time today talking about that and what investors would typically be willing to invest in. And it does depend on the nature of the investor themselves, actually, a little bit as well. And then, the majority of our clients are C corporations. And we're going to talk about qualified small business stock, which is kind of the last item here. What a huge benefit that is for emerging growth companies, and maybe some pitfalls, some things not to do if you're going to form and want to ultimately have that kind of exit. So we'll jump right in here to entity structure. This is important. Some things, most things in the tax world can be undone, but some cannot. And so it's important not to make certain mistakes right out of the gate. I've seen some horror stories where things went wrong because of some poor decisions, maybe poor communication out of the gate, sometimes poor advice. But the simplest breakdown here of the types of entities that you see are sole proprietorships, LLCs, S corporations, and C corporations, and we'll talk about each of those here in a second, and kind of the reasons for going one way versus another. And then again, this kind of all dovetails into what we call the life cycle. What is the life cycle of a business? Typically there's a formation, some sort of idea, some sort of development, go to market, and then ultimately some sort of outcome, whether that just be, again, cash flow or that is ultimately some sort of liquidity event. But these are the phases that most companies go through. Most of the companies we work with intend to take capital of some sort and scale. And so these are the kind of the phases, kind of the startup, growth, maturity, and then exit phases. And again, we'll talk a little bit more about each of those. Some of the key considerations when, thinking about, what kind of entity, thinking about, kind of tax decisions. I won't go in great deal into any of these, but, kind of projected income. What does that look like? What's the time horizon to pivot towards profitability? Is that a day one thing? You have a high margin, low investment type of business, or is that down the road? Distribution needs, do you take money out of the business? That makes a big difference on the type of entity you would choose to go with. There's a lot of flexibility with certain types of flow throughs, less so with C corporations and double layers of tax potentially. Again, growth timeline. There are some things that you can do. You could start out as an LLC, for instance, or sole proprietorship, and then ultimately incorporate. But some of that is really based on timing. When does it make sense to make those moves? When's it advantageous? When's it not? And it's just something you'll need to take into account when making that determination. Risk assessment. Most of the entity types that I just rattled off a moment ago have some sort of liability protection. The exception to that is the sole proprietorship. If it's done outside of potentially a single member LLC, which even though there's technically an entity there, it's because it's single member, it's disregarded for tax purposes, at least for income tax purposes. So that's one of the things to keep in mind. Are you in a high risk business? Is it worth having a separate entity? There's a cost. Anytime you set one up, you maintain it, there's a cost to doing so. And the question is, does it add value or is it just being done? You just want to think that through. And then again, exit strategy. There are advantages and disadvantages to being flow throughs versus being a C corporation. It's going to depend somewhat on, again, time horizon, ultimate expected exit, and ultimate buyer. There are, a lot of great reasons to be a C corporation for exit planning. But then there's some industries where you simply can't sell. Everyone who's buying is buying assets, and it mitigates the benefits of potentially being a C corporation. And so you kind of need to understand the space you're in to get to the optimal structure out of the gate. Other factors to consider are state taxes. That's a big one. Flow-throughs, again, provide oftentimes a lot of flexibility. They have a single layer of tax, meaning at the shareholder or member level. But for multi-state entities, they can be very painful. They require a lot of compliance. The entity has to file in a number of states sometimes, and then sometimes the individual also needs to file in those states. And it just creates a kind of a layer of messiness that can be very expensive to maintain. International operations is a big consideration. There are some fairly favorable international provisions at the corporate level for C corporations that simply don't apply to some of the flow throughs or individuals that need to be taken into consideration. Industry specific considerations. We'll talk a little bit later around qualified small business, around R&D, but there are certainly some industries that lend themselves more so to flow throughs versus C corporations, and you just want to think about those. Owner's overall tax situation. This didn't used to be as big of a deal. The corporate tax rate was somewhat similar to the individual tax rate at the top end. The corporate tax rate was 34 to 35% at the top, and individuals were anywhere between 37 and 39.6. Well, that's changed. With the first Trump Act, the corporate rate dropped down to 21%. So there is a pretty decent sized delta between the tax rates. And so, again, it's just something that needs to be taken into consideration when looking at how you're going to form, are you going to retain those earnings? If you're, are you going to distribute those, which mitigates some of the tax benefit in terms of rate arbitrage? It's just something you're going to want to think through. And employment tax planning. There's, things like giving employees stock options. Very straightforward, honestly, with corporations, with C corporations, not as much with flow throughs. So it's just something that needs to be taken into account, depending on how you want to compensate your key employees. So now we'll dive in a little bit deeper into each of the different types of entities. So sole proprietorships, it's what it sounds like. It's the simplest form. You essentially just go out and conduct businesses yourself. It goes on your Schedule C of your individual tax return. There's less cost to setting that up. There's less maintenance, but it's fairly uncommon, to be honest, outside of certain consulting type arrangements, to operate in that form. And certainly you're not going to raise money in that form. But it is the simplest. Again, whether you're just doing it in your own name or you're setting up a single member LLC, which gets taxed in the same way as being a sole proprietor. It does provide some legal protections by setting up a single member LLC. But it also can create, some maintenance costs. There's the annual fees typically with those, depending on the state. I think most of this group's in California. There are some LLC fees to California that would have to be paid. And so, again, it's not, in my practice at least, we don't see a lot of sole proprietorships. The next, probably most common and is used, extensively with, real estate industries, professional services, are partnerships or LLCs. They're both taxed as partnerships, typically, unless you make an election not to be taxed as a partnership. But there's some advantages to LLCs in that you get some legal protection and you have just a ton of flexibility. You can allocate income the way you want. You can bring in new members, and if you do it correctly with profits interest, avoid kind of an upfront tax situation. You can get very creative with partnerships, and to me, that's one of their big advantages. There is a single layer of tax, which is advantageous as well, meaning that everything within a partnership flows through the ultimate members or partners of that partnership. And again, that can be attractive. And again, if you're going to end up selling assets in the end, it's a great alternative because if you're not going to sell stock, you don't get to take advantage of some of the benefits of being a corporation. And yet you get a lot of, flexibility along the way. One of the big disadvantages of partnerships is that if you're a member or a partner, you're not an employee. And so you can't run wages essentially for yourself, which can complicate things like mortgages and just having to make quarterly tax payments and calculate and stay on top of that can be a little overwhelming, honestly, for some people. And certainly it's a limitation with employees because if you make someone even a fractional percent, likely they're no longer an employee. They're now a member or partner in the partnership. And, for a very small ownership percentage, it's a pretty big burden to put on employees to no longer be able to get a W-2. So it's just something to be aware of. But again, a lot of flexibility, and it's relatively easy, barring certain kind of debt exceeding asset situations to switch later into a corporate form. It's a very simple process typically. But in states like Delaware, it's a simple, 1 or 2 page form that gets filed. It's again very simple. The next option that's out there that we see are S corporations. Again, it's still a flow through, meaning that there's typically not much of an entity level tax. There is in California. There's a 1.5% entity level tax in California. It's rare. It's one of the few states that actually does that. There are limitations on the number of shareholders, citizens, what type of individual can be a shareholder in an S corporation. I don't see a lot of S corporations in my world because they're great for simple family-owned businesses, professional services, things of that nature. But they're more rigid than partnerships or LLCs. The income has to be allocated in a very specific way. and they eliminate the ability to get qualified small business stock treatment. And so none of my tech companies are or should be an S corporation. We'll talk more about that here in a little bit. And then C corporation. That is the majority of my practice, for instance, in our firm. Most of our clients are C corporations because they plan on taking money. And most institutional investors, there are exceptions, but most institutional investors want to invest in C corporations. It's what they're used to. They don't want the flow through attributes of an LLC or an S corporation. In fact, they really can't invest in an S corporation. They typically are some sort of partnership structure, and it would disqualify the S corporation from being an S corporation. So typically, you would only see an LLC or a C corporation, and the LLC is very uncommon. You see a little bit more of that with angel type investors or certain types of transactions, but not common. So most of the time, if you know you're going to go take money, being a C corporation is where you ought to be. Again, it's all about looking out in the future and trying to determine the best you can what you think the future is going to lead to, the exit event, investment, things of that nature. But legal protections here, and again, most of what we see in the tech and life science world. So here we just made a simple grid, and we'll definitely hand out the slides at the end of this, and so people can have this. But we just wanted to kind of summarize a little bit here, kind of the different things we had talked about. But you'll have this after for reference. So key takeaways here is that there is no one perfect entity choice. It really very much depends on industry, where you're going, complexity, cost to set up, and whether the qualified small business stock, which we'll talk about, is something that matters or something that you're even qualified for. But it's one of the biggest tax attributes or kind of favorable provisions within the tax code in the US that I think everyone should really understand if you're starting a business. So now I'll talk a little bit about compliance and deadlines. And again, this will be handed out at the end, but it's just good to know what generally your obligations are as a business owner, someone operating. And so we'll just at a very high level walk through here. No need to memorize these, but just so you have a general idea. So, why do deadlines matter? It seems like unlike homework in school today, there are not a lot of second chances if you miss deadlines in the tax world. So, you want to avoid penalties, particularly around payroll. They can be painful. There are some first-time penalty abatement, situations where you can get out of penalties if you find yourself in a bad spot, but you want to avoid that. You only get the one time, within a given period of time at least. And so, and when you file tax returns, one of the things I think that people don't fully understand typically is that when you file a tax return, you're actually making elections. And those elections are sometimes called methods. And once you've adopted a method, you can't just switch your method in your tax return. You actually have to apply and get IRS consent. There are automatic consents sometimes, but it still requires additional paperwork, additional cost. And so it's one of those things where, we'll sometimes get in very early, and we have potential clients who are a little surprised at how early we'll get involved. And my reasoning for that is simply that if we don't get in right out of the gate, sometimes by the time we inherit some work that's been done, there are things that we can't easily or cheaply undo. And it's just a shame to see that and have to dig our way out of some holes that people make. It's, very common, honestly, for entrepreneurs. They go with what's familiar, and they go with a tax provider that maybe doesn't live in this particular space and doesn't know the issues that they need to be avoiding. And we see it regularly. And so it's just something to be careful with. And yeah, early mistakes can compound sometimes. And again, when we get to QSBS, I have one story where I have a client that made a minor foot fault, honestly, just a miscommunication, and ended up costing them millions of dollars in the end. And it was a shame to see it all happen. So here's just some of the bigger deadlines. So January 31st is when W-2s and 1099s are due. So that's obviously already passed for this year. There are penalties for failing to meet those deadlines. They're not huge, but if you have high volume, it can become a problem. March 1st. Most of our clients, for instance, I've mentioned are C corporations, and most of them choose to incorporate in Delaware. It's not that you have to incorporate in Delaware. You certainly can incorporate in California, but most of our institutionally backed companies choose Delaware. It's for legal reasons, not so much tax reasons. They have a lot of case law, very favorable corporate governance rules, and so people choose to incorporate there. And frankly, the attorneys are just used to doing business in Delaware. And so that's what a lot of their templates are. It tends to be cheaper. Every once in a while, we'll come across someone who uh, read on the internet, Wyoming or pick a state, and they choose to go that route. They see Elon Musk doing it. And I would tend to avoid that, to be completely honest. It's expensive, it's unknown. Most attorneys don't do a lot of work in that state. They don't have the same level of precedent that some of the states like California or Delaware would have. Again, maybe some lawyers would disagree, but I think it's a mistake to incorporate outside of either your home state or Delaware. March 15th, that is when S corporation returns, which is the 1120S, and that's when partnerships are originally due, the 1065s. And partnerships include LLCs. That is a change. That used to be the other way. Those used to be due April 15th, and corporations were due March 15th. They switched those a number of years ago, which makes a lot more sense because you need the K1s from the S Corps and the partnerships in order to finish your individual return. So it only makes sense that those are due a month before the individual, the 1040s due. So April 15th is when corporate returns are due and when individual returns are due. And then you've got the FinCEN, which is oftentimes referred to as FBAR. That's for foreign bank accounts. If you have a bank account in excess of $10 million, you have a reporting obligation. That's when that's originally due, and the penalties on that can be draconian. In fact, up to half of the bank balance. So it's one of the ones not to miss, not to mess around with. And then you've got the forms 5471, 5472, and 8858. Those are all international forms. If you have a foreign subsidiary, you have a foreign parent or a foreign branch. Those have very high penalties. So failing to file those timely, depending on whether you have a particular schedule in them, can be up to $20,000, or at least beginning at $20,000. Intentionally not filing those can be a criminal act and also into the six figures in terms of penalties. The IRS has become much tougher. Used to be very easy to get those penalties waived. We don't find it as easy anymore. We do when we absolutely have to. We will write letters to make that happen, but it's just something to be very careful of. I do run across every once in a while, particularly India for some reason, where someone will maybe be from India. They'll set up an Indian subsidiary, and they just have no idea that they have this requirement, and the penalties can become big in a hurry. So just something to be very careful of. April 15th, June, September, and December, that's when quarterly estimated tax payments are required for corporations. And then the annual Delaware franchise tax, June 1, for LLCs. Like I already said, March 1st is for corporations. So, in the startup world, people often ask, what are the biggest areas to avoid, running afoul of? And I always lead with payroll. Too often, I'll be talking with founders, talking with smaller businesses, and they'll tell me that everyone's a contractor, even them sometimes. And the states simply won't stand for that. Executives, California particularly, will automatically classify basically an executive, a C-suite, as an employee. And it's one of the few areas where, because it's trust fund money, that the IRS can actually pierce right through your legal entity. Corporations, LLCs give you some legal protections, but not in this area. So it's where I warn clients, get people on payroll. There are cheap solutions out there like Rippling, Gusto, a number of others to do that. And it's just one of the areas just not to mess around with. I won't go into all the detail that's here on the slide, but I just want to caveat that that is one of the highest kind of pain points for early stage companies in terms of making mistakes. Yeah, so just key takeaways. I would suggest, obviously we'll give out the slides here, keeping a calendar of key dates. It's, when you're running a business, last thing you're going to be thinking about is tax filings, honestly, and you're going to be busy trying to expand, grow. So you just need to keep organized, understand when those happen, and try and stay out in front of them. Most of the forms that I mentioned, I just provided the original due date. Most have extended due dates, which again is a very simple, kind of 1 to 2 page filing to get those extensions. So just be aware you do have some extended due dates. So fundraising and tax implications. This is in my mind one of the biggest kind of pivot points in terms of deciding on what kind of legal entity you want to be. Um, there's the qualified small business stock is just a huge benefit. It allows you to exclude a significant amount of tax potentially, at least federally. California does not adhere to that federal code section, so it doesn't apply to California level taxes, but it does federal, and the majority of the states actually do, apply the qualified small business provisions. And so getting into the right form out of the gate is important. If you know you're going to take funding, I often tell my clients just go straight to a C corporation. Sometimes in the first year they'll know they're going to be putting some of their own money in, and they're going to want the flow through the losses to matriculate to their return. That's fine, but for the small dollars saved, sometimes you end up in bad positions, and you just want to avoid some of that. Your ability to then later convert can be somewhat challenging if certain things happen. So, as I mentioned, most institutional investors want to invest in C corporations. They don't like the flow through attributes. They just want to own the stock. They potentially want the QSBS treatment. And this is just kind of the norm. And with most, kind of growth companies, you don't want to overstructure things. And we do see this sometimes, particularly with very, very smart engineers. They are very bright and they like to do their own research, and sometimes they over-engineer on the tax and legal side out of the gate, get themselves in positions where it's very hard to manage their own entity, and they start making mistakes, and those mistakes can cost money. And so, I speak with attorneys about this all the time. Most of us that kind of play in this world just recommend being very cookie cutter, very simple. It's easier to get investors. It's less confusing. You're less likely to make a foot fault, and it's just the norm. It's last thing you want to be doing is you're trying to either raise money or exit is explaining why you have a super exotic cap table or an extremely challenging stock comp plan. It's just not worth it, in my opinion, most of the time. So, the advantage of corps is one, obviously the QSBS we'll talk about, but also the ability to issue different classes of stock. Typically, founders will issue themselves common stock, and most employee stock comp plans focus on common stock, whereas most investors want to invest in preferred stock. It has, typically liquidation preferences, and so they want to make sure that they're in a kind of preferential share class, and that's why they take preferred. There's oftentimes fairly large valuation differences between preferred stock and common stock. And as a C corporation, if you're going to give equity to employees through stock options, is the most common for emerging growth companies. Public companies that have a market have not entirely, but moved away from stock options and do a lot more in restricted shares, RSUs, RSAs. But that's because there is a liquid market for employees to get the ability to liquidate some of their holding to pay the taxes, whereas privately held early stage companies don't have that ability typically. And so stock options is pretty much the norm. If you're going to be issuing stock options, if you've not heard of this before, 409A is a requirement to get a valuation or to put a valuation on the stock option grant price, which is the exercise price. And there are some pretty draconian rules in 409A that apply penalties and apply interest if you make a mistake and you issue stock options in the money, meaning the strike price is below the current fair market value. There are some safe harbors in 409A that allow for certain types of individuals to not get a formal valuation and to do it themselves. I tend to recommend against that. I just think it's not worth the risk of having that challenge later. There are alternatives out there like Carta, for instance, which is a cap table management company a lot of our clients use, that for around $3,000, you can actually get a 409A valuation from them. It's one of those things that you should do on an annual basis. They last 12 months, typically, unless there's a major event. And then it is possible you have them more frequently, but you'll kind of know what that is. If you do a large fundraise, maybe an acquisition, it takes a fairly significant event to force you to get another valuation done. And it's one of those areas where, again, talking with people around where early stage companies sometimes make mistakes is in this area. And if you are very successful and you have a great exit, and then your employees later have a tax issue because of you issuing your options originally in the money, as an executive, you're potentially going to get sued. You created a situation for an employee where they thought they had this great windfall, and as it turns out, now they have a tax problem. And so no one wins in that situation. So it's one of those areas you just want to be very careful with. And honestly, once you have a 409A report, you can typically rely on it. Yeah, you kind of just throw it in the files and keep it. You don't do much else with it, but at least it kind of protects you. So 83B elections. This is for restricted assets. And an asset in this case can be stock. And so it's not uncommon for founder shares to, when a funding event happens, for someone to require reverse vesting. Or they just issue right out of the gate and shares that they want vesting on, they want restrictions on. And in that case, oftentimes what we do is we make an 83B election. An 83B election basically makes it as though that restriction didn't exist. It makes it as though you own the asset outright on day one. And that's important because if you don't make that election and it turns out that it is compensatory, meaning it's compensation to the employee or yourself, as the asset vests, as the stock vests, it can be compensation at that time. And the value may increase over time. And so you can actually end up with tax bills individually that you weren't expecting and that you maybe don't even have liquidity to pay. And so, when you have restricted shares, you ought to be thinking about 83Bs, at least consulting on it, whether it's something you should or shouldn't be doing. And you only have 30 days after the issuance of the shares to make this election. It's very simple to file with the IRS. You should provide a copy to the company so they have it in their records as well. But it's one of those things where there's really no fixing this. If you let 30 days go by and you don't make this election, you've missed that window. There are no do-overs. Sometimes you see people cancel, shares and reissue, and hopefully, the value has not gone up, between the first and second grant. But it's a bad situation when these get missed, and so just be aware of them if you have restricted shares. Convertible instruments. So, in the old days, convertible notes were kind of what people did before they went and had a priced round. Sometimes early investors don't want to price the value, or their founders don't want to price the shares early on. It's difficult to value. And what they want is when the larger investors come in, whether it be a seed or a Series A, to be the priced round and to set the value. Typically, not always, but typically you're dealing with more sophisticated investors at the time, and they're more capable of setting the price. And so convertible debt used to be the norm. You would issue, essentially the company would issue debt. Then upon the next round, that debt would convert into equity. The problem with that is that even though there's just vast non-compliance in this area, is that technically the individual has interest income that's accruing, even though everyone knows that it's highly unlikely that interest is going to get paid, because the intention is for that to basically roll over into shares. And the bad part is that the company doesn't get a deduction because it's considered disqualified debt typically, but the individual actually has phantom income. So, because of that, the Y Combinator came up with what's called a SAFE, simple legal agreement for future equity. And you can even go on the Y Combinator website and actually see their standard agreement. Most attorneys that I see use kind of the Y Combinator template, maybe with some modification, but they've kind of set the standard in this area. There's, kind of debate amongst the tax nerds as to what exactly a SAFE is. Most practitioners treat it as equity. The Y Combinator agreement says specifically in the last paragraph that it's equity for a number of reasons. 351, which is contribution, as well as QSBS. But again, I've not seen it litigated yet. We'll see if that holds, but that's kind of the norm, the way those are being treated. And so that's really what's normally used these days are safes, pre-funded round, priced round. So just be aware that that's kind of the standard mechanism. This is just basically what I said a second ago, that there are, with convertible debt, there's some issues with phantom income. If you have foreign, basically investors, you can have withholding tax issues. These days, I just don't see a lot of convertible debt. And when I do, it tends to be entrepreneurs that have been entrepreneurs for a long, long time, and just that's what they're used to, and they're just not going to change. But most newer entrepreneurs are using safes. So option pool, this again, not giving advice here at the size of an option pool, what's standard or what should be. There are services like Carta that will give you some more benchmarking, but what we typically see is 10 to 20% of shares are reserved for employees. And that's just, again, what we see in practice. That doesn't need to be the number. It could be more, it could be less. Kind of depends to some extent as well as number of key employees, what they're doing, the maturity of the company when you start to have those employees. There's just a whole lot of factors that go into the pool size. But it's one you're going to want to spend a little bit of time thinking through. On one hand, you want to attract the best talent, so you want to be able to give away some of that equity. On the other hand, you don't want to dilute yourself too much. As the founder, the primary idea person, you just want to be careful there, not give it away. So, yeah, I don't think I'll spend a lot of time here, but again, we'll get the slides out. But these are just some of the things to consider, when you're looking at fundraising and tax implications, and QSBS and 409A and safes, and again, you can look a lot of this up and talk to an advisor, but these are the key takeaways. So, founder pitfalls, things to avoid. So, yeah, so incorporating after, you have already raised funds, can be problematic. You could end up in a situation where you don't get qualified small business stock treatment. It's somewhat rare. Most LLCs, if you convert them to a C corp later, will retain their QSBS treatment, or at least start the clock on the QSBS. But you could end up in a situation where it does not, depending on the value of the company at the time of the conversion. So it's something to be careful of. Ignoring franchise taxes is one where, I think people just assume that if they don't have income, they're not going to owe any tax. But for instance, the Delaware tax is a franchise tax. It's based on the value of your shares. And there's a whole calculation. There's two calculations, in fact, that you use to calculate how much you owe Delaware if you're incorporated there. And you get to choose to basically go with the lower of the two calculations. But just be aware that it's out there. And that's sometimes when you have non-compliance, people think they didn't owe anything. So what's the possible downside? Well, sometimes they do owe, and they're not expecting that. and then they're racking up penalties and interest. I talked a little bit about misclassifying workers. That's, using too many contractors. There's a number of criteria out there in terms of who's a contractor versus an employee. There's a little bit of gray area, but it's one of the number one areas to watch out for. And then again, 409A, get the valuations, protect yourself. So, next steps for founders are, picking the right structure. We talked a little bit about that today. And again, it's not where you are now, it's where you think you're going to be. Tracking deadlines, documentation for fundraising, QSBS, and then, what I would suggest in terms of service providers, find someone that does a lot of work in exactly what it is you're trying to do. So, I, for instance, do a lot of work in the tech space, and I work with just a lot of founders in this space. If you're an auto dealership, I'm probably not your guy. I'm probably not the right choice there. You want to find someone who does a lot of auto dealerships. I think people just assume that lawyers and accountants, because they do this for a living, can cover a lot of ground, and to some extent that's true, but you do want to find people who specialize and ask the questions when you're going through the process. And before I get to the final takeaway, I kind of alluded to qualified small business stock, although we never really got into that. And I mentioned I was going to, just talk about a story. Qualified small business stock is a provision specific to C corporations. And it's either referred to as qualified small business stock, QSBS, 1202, which is the code section. But it's kind of an amazing provision. And before July 4th or July 5th of 2025, basically what companies were allowed to do were, if you got originally issued shares, you were in a non-prohibited industry, you held those shares for 5 years, you avoided certain types of redemption transactions, you could potentially exclude $10 million or 10 times your basis. But for most founders, it was the $10 million if you meet all the criteria. And again, it doesn't apply to California, but it did apply for federal. It's just one of the biggest benefits in the tax code. And that's why most tech companies go straight to C corporations, is to make sure that they get that treatment. It changed on July 5th of 2025 to the favor, and a favor of the taxpayer anyway. And changed so that now you can exclude $15 million of gain on an exit. And the holding period also became more favorable. 3 years, you get 50%, 4 years, 75, and at 5 years, 100%. It used to be if you didn't make 5 years. So if you sold in 4 years and 11 months, you didn't qualify. And there's another code section, 1045, which could give you some partial rollover relief, but you didn't get the full benefit of the qualified small business stock provision. And so they did change that. And again, they also bumped up the size of the company from 50 million to 75 million that can issue stock that would qualify for qualified small business stock. I did have a client. I mentioned I was going to tell a story where the founders, I honestly, they were working with great attorneys. And I think they just didn't fully know where their company was going or explain it well. And they set up as an S corporation on year one. And then they decided they were going to make, go raise money about 6 months later. And so they naturally were going to convert into a C corporation because they're bringing in non-qualified shareholders. There was some structuring that could have been done that didn't get done. And because of that, they ultimately had some pretty big exits, well in excess of each of the two founders, well in excess of the $10 million mark. And, even though they were only an S corp for, again, less than 6 months, they tainted their shares and they never were going to get the QSBS treatment. And so each of them paid, $2 to $3 million more than they should have otherwise. And so it was just a shame. And then ultimately, unbelievably, that was in a tender offer that they lost that benefit. They paid that extra tax. The company took on debt and didn't scale like they thought they were going to. And they didn't have a good second exit. And so on their one good exit, when they pulled some money off the table, they just paid maximum taxes. And it was just really a shame. And it's one of those things where, if it had been thought through up front and they had picked more carefully, that one event, and hopefully entrepreneurs have more than one great event in their life in terms of an exit. Most don't. And so you want to make sure you optimize that opportunity. And so it's just critically important that you work with advisors who understand the rules, that you understand at least enough to know not to make certain decisions. And that's really, why I wanted to come here today and talk to people and just try and help them understand where, the few spots that I've tried to highlight where there really is exposure. A lot of times, founders will tell me, oh, it's very simple. We don't have many transactions. That's all good, but I don't think people realize that some simple decisions they're making up front potentially have long-term ramifications.